Hey everybody, it's Craig Berry, Atlanta area's #1 mortgage professional with Acopia Home Loans, and I'm coming to you today just outside of my office on this beautiful day, hence the sunglasses, not just trying to look cool and just trying to take advantage of the weather. But anyway, I want to talk to you a little bit today about some useful acronyms and terminology when it comes to getting a home loan, because as much as we try not to do so, us mortgage lenders tend to speak our language, and our language may be a little bit confusing, especially when we start throwing in acronyms. Much like your business with what you do, I'm sure there's things that you could talk about that would go right over my head. Same rules apply. So I want to try to help you out a little bit today and give you some helpful nuggets. We're going to touch on 5 of them, and I'm going to try to touch on them as quickly as I can and hopefully in as much detail as I can so that you'll have a good understanding, so the next time that you go to get mortgage financing, you'll have at least a little leg up. So let's jump right into it. LTV, that's the first one I want to talk about. Loan to value. That is the ratio that very simply factors in the amount that you owe on your mortgage according to the price or value of your home. So you divide one into the other. So let's say that you owe $80,000 and your home's worth $100,000. You divide 80 into 100, that gives you an 80% loan to value ratio or a 20% equity position. It's that simple. Next up is DTI. DTI stands for debt to income. And that is a ratio that is extremely important because it determines how much home for which you may qualify. Your debt to income ratio consists of a front end ratio and a back end ratio. Your front end ratio is your total housing expense, including your principal, interest, taxes, insurance, mortgage insurance if applicable, homeowners association fees if applicable, and you divide that into your monthly income. That gives you your front end debt ratio. Your back end ratio takes all those numbers that I just talked about, you add that to your other debts, such as, say, car payment, credit cards, student loans. Any other monthly debt that shows up on your credit report is going to be considered part of your back-end debt ratio. So understanding what your front-end and back-end ratios are and what you qualify for is going to determine how much home that you can buy or how much you'll qualify for when it comes to refinancing. Next up, PITI. Now you'll start to notice that these things start to come together a little bit because PITI is essentially your mortgage payment, and it represents principal, interest, taxes, insurance. So your principal, interest, taxes, and insurance are all very relevant because they help calculate your DTI or your debt ratio. So you want to know how to calculate your PITI so that you can calculate your DTI and know what your qualifications are. It's much easier if you talk to a mortgage professional about these things, but if nothing else, with a good mortgage app like what I have, you can go straight in, calculate these numbers, and with the help of a mortgage professional, you'll be able to calculate what you qualify for. Next up is PMI. And PMI actually factors into your PITI, which again factors into your DTI. So PMI is private mortgage insurance. There's PMI and there's MIP. Both of them are essentially the same thing. PMI is private mortgage insurance for conventional loans. MIP, mortgage insurance premium for FHA loans. Both of them are just mortgage insurance for the lender in the event of default by you as the borrower. They're very, very important because, again, it's going to determine your debt ratio. And remember, and we'll talk about this in another video, PMI or mortgage insurance of any kind is not always a bad thing. Most people hate it, but sometimes it can be the difference in you getting a great loan. So it's not always a bad thing. And the last thing I want to talk to you about today is the best of all, the CTC, clear to close. So when you get your loan all the way through final underwriting and everything has been signed off on, you will then receive your CTC, which again means clear to close, which means that you can get the keys to your new home, or you can finally be done with that refinance and start reaping the benefits that you set out to do to begin with. As always, I'd love to talk to you more about acronyms, about terminology, about any and all things related to real estate and mortgages. That's what I'm here for. I'm passionate about what I do, so would love to chat with you. My contact information is going to be at the bottom of the screen. Feel free to call me, text me, email me, whatever it is that's the easiest for you. I'll try to do my best to adapt. I thank you so much for watching today. I hope you're enjoying some of this beautiful day wherever you are, and until next time, make it a great one.